Evening, everyone. So, staying with the technical theme, I wanted to take a step back and revisit support and resistance in a little more detail and really think about how we use that information when developing our trading strategies and how it can help us with our trade entry and exit levels. And to make it a little more relevant, I'm going to use the hourly Aussie dollar chart from June 21st as kind of a case study, as it really does encapsulate a lot of the things that I look for in price action and markets overall. So I think the first thing I want to know is that the way markets and prices evolve is that the majority of time, and this perhaps as much as 75% of the time, is when markets are thinking about the actions that they want to take, and perhaps only 25% of the time actively executing those actions. So especially at the moment, with the focus on inflation, higher rates, and the impact that may have on regional and global economic activity, this is the cycle we're seeing playing out at the moment. As new information, data, etc., is released, we're seeing sharp price moves as markets adjust with new information, and then a period of consolidation or recovery while we might wait for the next set of data and information to gauge whether further action and price adjustment is warranted. So I've been a US and Europe market bear since early this year now, but I think in the last several weeks, we're now seeing the fundamental backdrop in place for Australia that suggests we could be in a new phase of more negative price action for the Aussie dollar. We have an environment of rising rates, which is impacting growth expectations and consumer confidence everywhere. But Australia, as a commodity producer, is also seeing slowing demand impact commodity prices. And that's obviously got a knock-on effect for their currency. So I have my thesis that I expect the Aussie dollar to underperform in this environment, but we need to check the charts and see what they're indicating. So let's recap our definitions here and apply it to our Aussie chart. Our support areas are the levels where the market encounters buying support that exceeds the available supply, and therefore prices begin to recover. And here we see that happens several times near the 68.60 level. By contrast, our resistance areas are the levels where the market encounters selling resistance that exceeds the available demand, and therefore prices peak and turn lower again. And we see several tests here between 69.40 and 69.65. And it's really just simple demand and supply characteristics. So my note here is that obviously we can't trade with the benefit of hindsight. The chart looks great here, but we can't possibly know that it will develop this way when we are at the beginning of the range period on the 22nd or 23rd of June. So it does look a lot easier than it actually is. However, it is a tradable range if we're able to develop the strategy early enough. So let's take a look at that. How do technicals help us identify if we're moving into a range environment? All right, so at the beginning of this chart period, we're actually in a we're actually in a downward trend characterized by a series of lower highs and lower lows. And our first interim low here is on June 22nd at 68.80 before we rally back up to 69.49 later that day. And bear in mind that there's no indication yet that the downtrend is ending, as we still need further confirmation of support. So on the next sell-off, we make a marginal new low down to 68.69 on June 23rd, before again seeing prices recover. So tentatively, it looks like support could be forming, and it's potentially the first sign that this is a tradable level. If I'm looking to buy, I should place my order ahead of the 68.69 level with a firm stop on a break through this support area. And be wary of placing your stops too close to a support or resistance level, as it's very common to see a spike move that briefly exceeds the support or resistance. And typically I'd suggest in a range of 10 to 15 points to protect against that possibility. But you might want to consider adjusting your leeway depending on the level of market volatility. So in this instance, our first opportunity to trade is to buy that dip towards the support. And we actually see a dip to 68.75 later in the day on the 23rd. If we do go long here, our initial target is that prior 69.49 high, and taking profits ahead of this would just be good risk management. Anyway, all right, so our next rally sees prices rally to a high of 69.57 on June 24th, and again at 69.58 on June 27th before selling off again. And this only marginally eclipses the prior high of 69.49 on June 22nd. And it's really our first indication that the market has transitioned to a range trading environment. So my key levels here to pay attention to are that 68.69 support area and the 69.58 resistance area. If we have a defined range where we can trade near the extremes with a close defined stop, you can also consider reversing your position near those extremes. So near the resistance level, you could actually go from long to short and vice versa if you're near the support. So that brings us to the final piece of our puzzle here, how to recognize a range breakout in order to participate in the new directional move. Before we look at that, there's a couple of important nuances about ranges that I mentioned last week and that I mentioned before and bears raising again here. Most importantly, the longer a range persists, the more we will see missed buy and sell orders above and below the market brought inside the range in order to get filled, especially as we approach key market data and announcements. And there's a twofold effect here. First, the additional liquidity of supply near the resistance and demand near the support will tend to reinforce the range. And you'll actually even see the range start to contract. And secondly, now that those orders no longer exist outside the range, there will be a bit of a liquidity vacuum when prices eventually do break either the support or the resistance. And so when we do see that range break, it's pretty common to see a near-term acceleration of price in the direction of the break. And we see that pretty clearly here for the Aussie. As prices broke through that 68.60 support last Friday, prices accelerated rapidly to the downside as new selling overwhelmed the buying interest. And this saw us trade down to a low of 67.63 before recovering later in the day. So remember, when you're exiting a position or entering a breakout trade, it's really critical to leave those firm stop loss orders because these markets can and do move very, very quickly. I'm going to leave it there for today and wish you a great week ahead. Thanks very much.